Welcome to the AssetMark Guided Portfolio Solution webinar. You are in listen-only mode. Today is Monday, March 30th, 2020. I want to thank you for taking a few minutes of your day to spend with us. We certainly hope that everything is well with you, your family, and all your family, friends, and loved ones. Today's call is specific to one of the investment strategies that we use here at at Anchor Pointe Wealth Management. We use the Guided Portfolio Solution Strategy, or we call it GPS. And since the economic turmoil started with the coronavirus pandemic and the turbulence in the oil markets, investment markets have been quite volatile in ways that we've rarely seen. Now, in our call today, we wanted to discuss how GPS is structured and share how its dynamic nature has adjusted during this interesting time. Joining me today is Kezia Samuel, Director of Client Portfolio Management at AssetMark, our partner firm who creates this great strategy. She's responsible for communicating the investment process, positioning, and performance on the guided portfolios to our clients. She's also responsible for writing commentary on market performance and current events. Kezia has over 19 years of experience and has transferred to the Investment Strategies Group in 2019, joining AssetMark through the acquisition of Global Financial Partners in 2019. Now, prior to working at Global Financial, Kezia spent 3 years as a senior portfolio strategist at Jackson National, and 4 years as an investment team lead for JP Morgan's private bank, and 8 years as a derivatives trader for the investment bank at JP Morgan. Kezia holds a BS in chemistry and computer science from Fordham University. She also has her Chartered Alternative Investment Analyst designation and is a Chartered Financial Analyst Level 3 candidate. So first, Kezia, thanks a lot for being with us today and sharing us some insight into GPS.
Thank you, Derek, and thank you all for listening in today. What I thought today, before we dove directly into the portfolios, was just set the stage, so to speak, what we have seen in the markets so far to provide some context before we dive into the portfolios. So first, what we saw was the fastest bear market unfolding in history. A bear market is a definition of a drop of 20% from peak. The peak in the markets was on February 19th of 2020. We saw that 20% drop happen in 14 trading days, or 22 actual days. The previous shortest time was 45 days. We've also seen the markets have its worst peak to trough decline of 35% approximately. That happened in less than a month. And just for context again, the last time we saw a 35% drop was in 2008 and 2009 during the Great Financial Crisis, but it took the markets a full year to drop 35% during the Great Financial Crisis, and which happened in less than a month during the month of March. In terms of the magnitude, the decline from peak to trough is right in line. That down 35 we hit and since then have bounced back, that's right in line with the average decline we see in a bear market. However, the speed of decline has been absolutely breathtaking. Recall, all of this has unfolded in approximately a month or less. The beating was not isolated to the stock side of the markets. In fact, bond side also took a significant jolt, so to speak. March 9th, we saw the unanchoring of the Treasury market, which is the U.S. government bond market. As typically we see in the marketplace, when markets panic and we are what we call in a risk-off environment, typically money pours into U.S. Treasuries and high-quality bonds. This time, during the crisis of the volatility, the height of it, this was genuinely different. We think that the combination of margin calls, which is investors who invest using leverage, as well as lines of credits being drawn and the need to simply raise cash, also created tremendous selling pressure on government bond and bond funds alike. The system was not prepared. It caught most market participants off guard, including the central bank. This is one of the reasons why the Fed has stepped in to cut interest rates and expand its balance sheet by putting into place credit facilities to provide liquidity and stability in the marketplace. So very important to note two sides of the coin. Both the stock markets as well as the bond markets were rattled by this extreme short-term rise in volatility. With that as a backdrop, as Derek mentioned, let's look at how the guided portfolio solutions, I'm going to call that GPS in short from now on, how it's built and how it has navigated these turbulent times that we all have faced. So with that, next page, please. The guided portfolio solutions, or GPS, is really built to reflect the AssetMark's investing evolved philosophy. The idea here is to think beyond traditional diversification. Typically, when you build a portfolio, you start with stocks and bonds. However, at AssetMark, we think it's important to take it one step further by adding in from core markets, which is where we're going to have stocks and bonds, not just here in the US, as well as the global economies, but to also add tactical strategies. These are strategies that are going to be able to de-risk when market volatility rises, like we saw in this environment, and or find a way to gather additional sources of return by finding cheap countries or sectors, but being tactical relative to a core market, which is always going to be invested in stocks and bonds. That's the next layer of diversification we add. But we don't stop there. We take it one step further by adding in diversifying strategies that can now both buy and sell, be it stocks, bonds, or commodities, and giving essentially more tools in the toolkit to some of these strategists and the portfolio managers, thus enhancing the story of diversification available to each client. Let's take it to the next slide, please. Let's start with the disciplined process in which we can add value, and that's the process in how GPS portfolios are constructed. It's a very simple three-step process. First is to what I call is build the foundation. With every house, I'm going to use the analogy of a house here. GPS is like building a long-term house. Every house starts with a core foundation. We want to make sure that the foundation of the house is solid. And that's the first step that we're going to take, making sure that we have the right building blocks, the right bricks, the right mortar to create the foundation in order to meet the appropriate risk and return tolerance for each portfolio. The next step is going to be which money managers do we want to bring into the mix, and using the house analogy, this is where we're going to build up the walls. And then finally, we know that a house with its walls and windows needs to adjust to what's happening outside. So do we need to put up storm windows, or do we need to open the window and let the sunshine in based on what we see happening outside the house? So how do we make adjustments given what's happening outside the portfolios? These are the three steps. Let's dive in and look at each of these in a bit more detail in the next slide, please. Let's start with the very first step, which is creating the foundation of the house. What you see on this page are three sample risk profiles: a conservative, a moderate, and a growth type of client. You can see we blend together the various ingredients that we've mentioned previously, which is core stocks and bonds, core equities, that's the blue component. We add the yellow components, which are these tactical managers that can pivot and shift. And then finally, adding the diversifying components, which again have the ability to take it one step even further and navigate and go short by allowing them to have more toolkit. Someone has used the analogy previously, which is the blue components of the core markets are like the chassis of a car. The yellow components are the steering wheel. It allows you to turn back and forth. And then finally, the red components that you see on the screen here are like the airbags. It helps you diminish some of the equity market volatility that you experience during an investing life cycle. But this helps us create this blend that you see happen here, going from left to right allows us to build the right foundation for each risk profile, which Derek will determine based on their conversations with you. So that conversation happens between you. But when we build each risk profile, we evaluate, does the blended mix get us to that right risk and return projection and profile over the long term? So that's building the foundation. We don't change the foundation. This is not where we're going to be making changes. However, on the next page, as you can see, when we blend the various strategists together, the strategists have the ability to make changes. This page here showcases all of the different strategists or money managers that are available on the AssetMark investing platform. And there's a variety of names here. The GPS portfolio management team is responsible for blending the right mix across each of these categories to create a complete portfolio. The job of actually making the strategist selection itself is not done by the GPS team. We rely on the AssetMark due diligence team, a team of 8 individuals whose sole job full-time is to talk to the money managers and the strategists to evaluate if they are doing what they stated out to be. So we rely on them to ensure that we've got the best in class across each of these broad buckets. Today, in a sample portfolio, we utilize across core markets a blend of American funds and New Frontier. American funds is a classic money manager that relies on looking at each company's balance sheet and evaluating if they offer value for the long term. In comparison, New Frontier is a top-down, more technical manager that looks to see which broad investments are offering value. We blend these two money managers or strategists to get you the right core market exposure. These managers are not going to be shifting how much they have in stocks back and forth. Instead, they always will have an allocation to higher quality bonds, which have provided ballast in this equity market sell-off. So within American funds and New Frontier, the allocation to high quality bonds like US Treasuries, despite the dislocation I mentioned earlier, certainly has provided ballast relative to the equity market sell-off that we have seen. However, looking at the tactical strategies, remember this is the steering wheel of our car. The steering wheel of the car allows me to make changes or move directions, and that is exactly what we have seen. Within the tactical limit loss category, the manager or the strategist that we work with is Savos, and they began the investing world starting February 19, being fully invested in the marketplace. But as volatility started to rise, they decreased their equity allocation all the way down to 25%. They work in a simple manner. As volatility rises, they de-risk the portfolio. As volatility will start to fall, they will naturally step back in. This is very important. This removes the emotional element of making decisions on when to exit and when to re-enter the marketplace, and allowing a manager like Savos, by systematically de-risking based on specified characteristics such as volatility, allows the portfolio to manage the risk we see without the emotional component of it. Finally, in the diversifying alternative strategy, recall this is the airbag component of the example that we were using. The strategist we work with is Alpha Simplex, that has been able to take advantage of the fall in oil prices by going short commodities. It has been able to take advantage of what interest rates have done, as well as what the equity markets have done, and providing a non-correlated return investment relative to the broad stock market. That is precisely how we add increased diversification into a traditional stock bond model. This gives you a sense of all of the different shifts. I gave you a flavor of the different shifts that we have seen across the portfolios by blending core, tactical, and these diversifying strategies, and thus having a better experience relative to a traditional stock and bond only portfolio. On to the next slide, please. The next slide is the third step. Recall I mentioned we put the foundation down, we built the walls using the strategist. Now it's time to decide, is it stormy outside or is it clear so we can let the sunshine in? And certainly I think we could all agree that it seems fairly stormy given what we saw unfold over the last 15 to 30 days. This allows, these are two proprietary indicators that the GPS portfolio management team utilizes to de-risk the portfolio based on what market conditions are telling us. Starting with the indicator on the left-hand side called the risk concentration indicator. This allows us to look at the actual underlying investments in the marketplace. I use the analogy of a shark. For example, if we were all on the beach in the water and you saw everyone running towards the beach, you, as a swimmer and being the only person in the ocean left alone, you're likely to look and say, well, why am I the only one left in the water? Essentially, this is looking to see, are all investments selling off simultaneously like we saw in 2008 and similarly as we see during other market panic sell-offs. This indicator did sense that, and on March 9th, did de-risk the portfolio, pulled some money out of the traditional investment and put it into the diversifying strategies. Recall that's the airbag, trying to diminish some of that volatility. On the other hand, the market environment indicator is looking at the big picture. So instead of looking at inside the markets, we're going to look on top of the markets. Here we look to see what actions the Federal Reserve has had on money supply, our credit conditions, the rate at which we borrow for businesses. Are they starting to look a little tight? And we did see this indicator also was elevated, and as a result, we did pull money out from enhanced return components and into, again, diversifying strategies. Both of these moves are, again, systematic in nature, not emotional. The ability to de-risk based on foundational principles differentiates the GPS portfolios from having to deal with the anxiety of, should we come out, have we come out too much, and when to go back. Both of these indicators systematically de-risk as well as re-enter the marketplace based on preset principles that have been evaluated through many market cycles. With that said, I want to take to the next page. This shows the portfolio management team, and I'll wrap up my main comments here. So what we saw here was, first, this was the fastest bear market in history. The S&P 500 fell fastest from peak to trough of nearly 35%, but we have come back significantly since then. We've gained almost 50% of the losses from the bottom. To put that in perspective, this is one of the fastest time frames that we have seen. Given all of these changes that have taken place, the team that you see here has been able to adjust as liquidity concerns spiked, as volatility spiked, to make the systematic adjustments within the portfolios. As an example, a moderate portfolio, as a broad conversation, started nearly at high 60s in its equity allocation relative to a 60-40 stock bond blended benchmark, and has de-risked that portfolio to nearly 50% in stocks, to give an example of what the changes that I mentioned along from the strategists and the indicators look like. What's critically important is that we've created a portfolio that can weather today's storm, but more importantly, be ready to benefit from the rebound, which typically also starts somewhere during the bear market. The best and the worst days often happens during the bear markets. Most investors think that happens during a bull market, but that's not the case. So in conclusion, the GPS portfolios are built to weather environments like this and to be able to make changes without letting the emotional aspect of all of our psyches take over. I'm going to pause there and Derek, see if there are any questions or if I could clarify any of the things that I have shared.
Kezia, thank you so much. You know, oftentimes when we talk about GPS, it seems kind of on the surface a bit complicated, but you know, it's elegant actually in its simplicity. And when you break it down the way you did, it really makes sense why it's structured the way it is. Now, one of the questions I think I first got, I think speaks to your analogy about the shark in the water. So why in times like this do we not see strategies like GPS or any other strategies for that matter going either exclusively to cash or predominantly to cash and then just waiting for the markets to heal and then investing back in?
And that's a very valid question. So note that within the GPS portfolios, some components of the GPS portfolios will potentially de-risk, as we saw our tactical limit loss strategists pull nearly from being fully invested and pulling it all the way down to 25%. It could potentially go lower if volatility remains elevated. But the entire GPS portfolio, meaning a 60-40 stock bond mix, is unlikely to go from 60-40 to 100% in bonds or 100% in cash. Here's why we don't. Here's what our research has shown, the effect of doing so. Research shows that the results of trying to time the markets, right? That's what we're trying to do. If we try to time the markets, is less than optimal. We looked at a portfolio of $10,000, invested it into the S&P 500, started in January of '94 and went to 2019. Derek, it really doesn't matter what time frame we do. We did this study over 26 years. It's the same over every time period. That $10,000 portfolio goes to $112,000. We then look to see the impact of the portfolio if we just miss 10, 20, or 30 of the best days in the marketplace over this entire 26-year time period. What we found was missing simply the 10 best days in a 26-year time span cuts the return by 50%. So instead of having a $112,000 portfolio, the portfolio's return is cut down by $56,000, nearly a 50% reduction. The results only get worse as you miss out more of the good days. One of the reasons we see this happening over and over again is that while the worst performing days definitely happens during bear markets, but so do many of the best performing days. They're often clustered together. So trying to time the markets and only missing out the worst days will also likely miss out the 10 best days. Just as we have seen over the last 2 weeks, we had some of the worst days on the Dow and the S&P 500, but we also saw literally 3 days later the best performing day in the market in 100 years, because they often tend to cluster together. One of the reasons why consistently as portfolio managers in the investment world, we don't make dramatic decisions within portfolio, rather de-risk the portfolio to the point where you can stomach the volatility that comes naturally with investing. Did I answer your question there, Derek?
No, that was great. I think that I'm guessing it also goes to say that that whole idea of remaining in the market, waiting for those good days, it's probably counterintuitive, probably because when you say that the media and just kind of the news surrounding the events is generally still bad, even when good things are happening?
Absolutely. Markets, the second point to this, and thank you for reminding me, is that markets and the economy are not one and the same. I think we as investors always conflate the two, but they're not one and the same. Markets will price in worse conditions before the economy actually presents itself. So the markets, when they fell, they were already pricing in far worse conditions than we have seen in the economy to date. We have not seen terrible news yet. They are anticipating what it is. Similarly, as it anticipates bad news, it also anticipates when all the bad news is done, often well in advance of the economy healing. So for example, 2008 and 2009, the market bottomed in March. The economy continued to do terrible all the way into late 2009, but the markets had already taken off starting March. So the two are reliant on each other, but they're not one and the same. So you pointed out the news cycle, etc. That's one of the reasons why, as investors, we look at the economy, the GDP, and some of these news. They are on a lag. The markets are forward-looking and often runs off well before we have adjusted to the news.
Okay, good. Thank you for that insight. Hey, another question we received, and I've definitely received this one many other times too, is in times like this, doesn't it make sense to buy gold or silver or some type of hard currency?
Typically, yes, and we have seen some of our strategists utilize gold as a position within portfolios, but we saw the same thing with gold as well. In this environment, when panic set in, we started to see gold, which typically tends to rise in value, also fall in value because of all of the uncertainty out there. So it certainly has a component in portfolios, and we allow our strategists that we select to make those decisions, but it's not the entire portion of the portfolio, given that A, it doesn't have a yield, it doesn't really offer outside of the downside protection, it doesn't offer a yield, and does not solve for all of the needs within the portfolio, typically as a high quality bond may or not. But again, it is a component. We allow the strategist to make those decisions, but it is not 100% of any given portfolio, given its limitations on what we can offer as part of the broader context.
Okay, and I think we have time for maybe one more question. And I received this question a number of times over the last, say, couple of weeks. And it also came in today. So prior to these last week where the markets were up a few days, and then I think today we ended up positively, but when the market seemed to be just going day after day of bad news, definitely had a number of investors say, what's going to keep this from going to zero? And am I ever going to get my money back? Can you give us some insight on that?
That's a question that comes up quite often. Interesting, investors think that the ceiling of an investment's return is unlimited and the bottom is always zero. That's not quite the way investing works. I'll give you two examples. I'm going to use one as a broad-based example. It's not a particular stock recommendation or anything, but a company like Apple, like just a broad company. I'm using my iPhone. Likely you as well, Derek, and most clients listening in on this call have some type of Apple type of product in their home, in their household. A company like Apple, which began as a $1 trillion market cap, does not go to zero because it has underlying value. It has intellectual property around the technology it has created. It has certainly some value, and what we find is at some point it gets cheap enough that investors want to step in as long-term buyers of it. Where that is always unknown, but it's certainly not zero. Why do I have some confidence around stating this? That's not to say that all companies are like Apple. There are certainly some with weaker balance sheets. That's why we allow our strategists to make the decisions, like American Funds, to determine which one has a better chance of navigating something like this. One of the reasons when we look at markets, and I looked at the stock market, the S&P 500 from 1926 to 2019, that's 93 years. In that 93-year time frame, we have seen the Great Depression. We have seen the markets fall in 1987. We have seen the Great Recession of 2008. That included the technology crash of 2000, 9/11. Despite all of these events, we find that the bull markets last an average of 6.6 years with a cumulative total return of 339%, while the bear market lasts approximately 1.3 years, with a cumulative loss of negative 38%. So the bottom of markets in each of these instances, including the Great Depression, is not zero. At some point, all of these companies that we look at will get cheap enough. And again, markets are much more forward-looking than the underlying economy is. So we don't think of it as a zero-sum game. It's not as binary as one may imagine it to be, but hopefully some of these anecdotes that I've shared around the marketplace provide some relief to that question.
Very good. Thank you, Kezia. That was great. And really think your insight and background on GPS and the strategies that you all are using really will be assuring to our clients that there's some important work being done behind the scenes. So thanks again for all of you who called in today. We certainly appreciate the confidence that you placed in us here at Anchor Point and with our partner firm, AssetMark. And we take that role so seriously. And so right now, more than ever, if you have questions about your financial goals or your investment strategy and how it lines up with your goals and your financial plan, we really want you to reach out to us. We're trying to communicate as much as we can, but if you have something very specific you need answers to, we're here. So just please reach out, let me know, text, email, or call. We're here to help you out, and we'll all see this thing through together. So until we talk again, have a great night, be safe, and be well. Take care.